Hello, I'm Kim Martin, Head of Funding Strategy and Engagement at New Zealand Debt Management at the Treasury. First, I'd like to thank you for your interest in the New Zealand market and to acknowledge the impacts that COVID-19 have had on every part of the globe, including your own. Today, I'd like to break the discussion into three sections. So first, the economic and fiscal outlook, and this forms the backdrop for the second section, where we'll detail our funding strategy. And finally, I'll highlight some key events that are coming up that investors may like to be aware of. I'd also like to draw your attention to the disclaimer at the end of the slide pack. Overall, the story is the New Zealand economy has performed better than expected over the past year and relative to the latest official economic and fiscal forecasts that were published at the budget on May the 20th this year. The economy had strong momentum coming into the most recent COVID-19 resurgence in New Zealand, so it's in a relatively good position to deal with the impacts. You can see here GDP was 1.6% in the March quarter, up 2.4% relative to the same quarter last year. Overall GDP output was above the pre-COVID levels in the March quarter and was showing strong momentum also in the June quarter. That strength in the economy was also shown in the June quarter release of labour market data. The unemployment rate returned to its pre-COVID low of 4%. And from the chart, you can also see this was a better outcome than even the upside scenario published at budget. Private sector wage growth also picked up strongly. In the June quarter, we also saw inflation rising sharply. The headline annual consumer price index inflation rose to near a 10-year high of 3.3%. And we could also see that the price increases were across most classes of expenditure, and particularly strong in the housing and construction costs. So that was the state of the economy as we entered the most recent COVID-19 outbreak in New Zealand. On August the 17th, a case of COVID-19 was detected in the community after a very long period where essentially New Zealand had been free of COVID-19. At that time, very rapidly, New Zealand moved to alert level 4. That's the strictest alert level in New Zealand, where essential businesses only are able to function, schools are closed, and people are asked to stay at home. Subsequently, just today actually, all of New Zealand south of Auckland has moved back down to a lower level of level 3. The table above here is Treasury's assumptions on the reduction of GDP at the various alert levels. However, we have seen in previous lockdowns that a significant amount of household spending and business activity is deferred rather than actually being lost during those shorter lockdowns, and the fiscal support measures have helped to counteract losses of income. That most recent announcement of New Zealand moving to alert level 4 occurred the day before the Reserve Bank of New Zealand was scheduled to meet for the August monetary policy statement. In the event, the Reserve Bank left the official cash rate at 0.25%. You can see here the market continues to price OCR hikes along with the Reserve Bank's own forecasts, which similarly show rate hikes. Separately, the Reserve Bank stopped its large-scale asset purchase program on the 23rd of July. So moving to the fiscal outlook, at the budget in May, forecasts for the total Crown operating balance was shown as above. The deficit was seen to be moving back towards zero by the end of the forecasts. As well as operating expenditure, the government also had plans for 65 billion of capital expenditure over the forecast period. So combined, the planned operating and capital expenditure resulted in a residual cash deficit shown here in the first 4 years of the forecasts. However, prior to the most recent COVID-19 outbreak, the fiscal data was coming in stronger than expected. The chart here shows cash deficit outcomes in blue at April and May relative to the forecasts, which are shown in green. The interim financial statements of the government, the 11 months ending the 31st of May, showed favourable outcomes. The core Crown residual cash deficit of 13 billion was more than 6 billion better than forecast, and this was owing to tax receipts being a lot higher than expected and operating and capital payment outflows being lower. The strong cash position also means that the latest net core Crown debt figures were better than expected. It was at 31.2% of GDP at the end of May. And at the time of the budget shown here, the forecasts were that net debt as a percentage of GDP would peak below 50%. So that's the economic and fiscal picture that forms the backdrop for the sovereign borrowing program undertaken by New Zealand Debt Management. So let's look at the funding strategy in a little more detail. These bars here show the New Zealand Government Bond Programme forecasts. The most recent forecasts are shown in green. The programmes, you can see, remain quite high by historic standards, but you can also see that being repeatedly revised down since budget 2020, really corresponding to those better than expected economic and fiscal outcomes. In addition, the borrowing programme has been set to allow for a build-up in a sizable liquidity buffer compared to history, and much of this buffer is held as cash in the Crown settlement account with the Reserve Bank, as you can see here in this chart. This means the Crown is very well positioned to manage any funding and liquidity risks in the current environment. We intend to provide guidance on the expecting level of enduring balances for liquidity at future economic and fiscal updates. The budget forecasts also showed that bonds on issue would increase to 190 billion by the end of the forecast period, as you can see here. We also announced we expect to syndicate 2 new bonds in the current fiscal year, so that's before June 2022. And we expected that the first of these would be a new 2051 nominal bond. We have subsequently announced that the May 2051 nominal bond is expected to be syndicated in the week beginning the 13th of September. So that's just a couple of weeks away now. As you can see above, this will extend the New Zealand government curve beyond the current longest dated bond, which is the May 2041. This will be the first time that New Zealand has had a 30-year point on the curve. So having a larger issuance program has allowed us to make the decision to extend the curve, as we're now confident we can maintain that point, as well as maintaining liquidity in the existing points in the curve. In addition, over a number of years, our funding strategy has aimed to increase the average weighted maturity of the New Zealand government bond curve. You can see from approximately 4.5 years in 2009, it recently stabled around about 8 years. If we were to issue 3 billion in the syndication of the 2051 bond, it would further increase the average weighted maturity, as shown by the dot on this chart. Adding a 30-year point to the New Zealand government bond curve would also align to the portfolios of many of our peers, as you can see here. And we have received feedback that a 30-year point on the curve is also considered to be a standard global benchmark bond. A long-dated bond would also assist us in our aim to continue to diversify our investor base. This chart shows all the syndications that we have undertaken since the start of last year. So looking at the 2041 maturity, you can see the longer dated bonds do tend to have a larger proportion of participants from investors outside of New Zealand, with investors across a wide range of regions. We can also see that in statistics that are provided by the Australian Office of Financial Management. Their longer dated syndication, including the 2051 maturity, also shows strong offshore participation. Beyond the insights that we can gain from syndications, we also have the aggregated holdings data provided by the Reserve Bank. This shows that the holdings of New Zealand government bonds by investors outside of New Zealand have stabilised above 50%. Recent syndication volumes have ranged between 3 and 7 billion New Zealand dollars. Book sizes have needed to be managed very carefully. On a couple of occasions, book sizes have approached 18 billion. For the syndication of the 2051 bond, we expect to issue at least 2 billion, with the transaction capped at 3 billion. And many of you will be aware New Zealand government bonds remain highly rated, with AAA domestic currency ratings from Moody's and S&P, and AA+ from Fitch. This chart shows current yields on New Zealand government 20-year bonds relative to similarly rated peers. So in summary, the New Zealand economy has had very strong momentum entering the most recent resurgence in COVID-19 in New Zealand. Government financial data was also surprising to the upside, and New Zealand debt management had built up a large liquidity buffer. This means there's a really solid foundation for a fiscal response as necessary. New Zealand debt management has a $30 billion bond program forecast for the current fiscal year. As part of this, we are planning to undertake a syndication of a new May 2051 nominal bond in the week of the 13th of September, subject to market conditions. This transaction will be capped at 3 billion. Just to note, this presentation is not an offer of securities and should not be used as a basis for an investment decision. We advise you undertaking your own due diligence. However, we are very happy to speak to you directly if you have any follow-up questions on any aspects. Please do feel free to contact me on the details shown. Once again, thank you very much for your interest in the New Zealand market. Thank you.